Today, you guys are going to learn what is an imbalance, or also known as FVG or inefficiencies. Now, a lot of people use a lot of fancy terminology. I'm not going to use any of it because at the end of the day, they're all the same thing. What I'm going to do in this video is I want to make sure that you guys understand what is an imbalance, how to use that, how to spot that, and take the best advantage of it. All right, so let's get started. Now, when you're on your chart, you're going to see many times, you definitely have seen a lot of candles going towards one direction. And in this case, in a sell scenario, what is happening here is that you see a huge candle to the downside. And then as soon as this candle closes, you're going to see the next candle coming after that, that is going to just retrace a little bit, so making this wick, and then it's going to drop. And then same things on the next one as well. But the biggest difference between this candle and this candle is that you see this wick going to the upside. Well, this wick has failed to reach at least the same level as this wick over here. And when this happens is literally the case where you have your gap, or also known as imbalance, because price is not delivered efficiently till this level. And look at this one. You see, this candle's open, it closes, and then you got another candle that goes a little bit higher, and this wick is tapping on this wick. So this is telling you, suggesting you, the price is efficient. So imbalance has been closed, and it just keep going down. So this scenario, when you have this, that's when you spot your imbalance, your gap. Now that you know what is an imbalance, let me tell you who creates an imbalance, who has the power to create an imbalance. All right. So usually when you see a candle like this size, like a big size, and it has all this volume, is going to be always institution, market makers, or banks, all these type of financial institutions, because we as a retail trader, we don't have the power to move market with that much volume on a daily basis, weekly or monthly basis. Okay. So the right question that you should be asking now is that where and when does this happen? So in this way, you can know how to spot them. So most of the time, all right, let me move on this one. Most of the time, what happens is that price builds liquidity, then it takes it out. And as soon as it takes it out, you will see that it run away immediately to the other direction. Now, usually, if you are not trading liquidity, but you trade support or resistance, it's like usually a fake breakout to one side, and then it goes away to the other side. And when they do this, is the time when they leave this type of imbalances, inefficiencies behind, which is usually going to be like a huge engulfing candle to the downside. And then you have a scenario where the wicks are not tapping to each other. Okay. So when does this happen? Okay. Most of the time you have this type of scenario happening on the swing high or swing low, or structural high, structural low. So what do I mean by this is simply like having price going up, going down, going up, going down, going up. So you see these lows, those are the cases where most of the time you will see price building up liquidity in a smaller time frame, all right, taking it out, so faking everyone out, and then price shooting to the opposite way. And when they do that, they're going to leave an imbalance behind. So if you have, like, let's say 15-minute structure over here, right, in M1, you have to spot this specific pattern that I just showed you above. And then you'll see usually there's a huge engulfing that leaves an imbalance behind. Don't worry, we're gonna go to the chart now, and I'll show you exactly what I'm talking about. So let's get to this one. We're already on GBP GBY, and let's take an example. All right, okay, let's look at this one. So check this out. You see how price is going to the upside quickly, and then what happened after that? Look at this. You have, okay, let me just zoom in a little bit so you guys can clearly see that what's going on over here. You see this wick, you see this candle is a huge candle. Then price closes, it goes a little bit higher, but you see how it fails to reach the same level as the previous week. So then this is your gap. Again, same things, huge candle to the downside, open a new candle, price goes higher and leaves a little bit of imbalance. So what do? You just take that as your point of interest, right? And now let me show you what happened exactly when price goes inside of the zones and how they react to it. Check this out. You see this? Price fills the imbalance and gives you a reaction. Again, one more time, let me stretch this all the way here, right? Look at this. It comes inside of it, and then boom, it gives you a reaction to the downside. Now, this is beautiful, right? So you can clearly see that price comes there, fills the imbalance, and then gives you a reaction. And it's going to be always like this because they have to keep going and filling unfulfilled order they left behind. All right. So now the key question here is like, how do you use it and how do you take the advantage of it? I know at first sight, when you see this, a lot of people get excited. Like me, myself, I was so excited and I was like, wow, this is beautiful. And guys, trust me, you don't have to trade that blindly. Okay. This one here is as same as any other tools they use in your trading, and you have to use that with so many confluences. You cannot just randomly go on a chart and be like, oh, I don't know, I see a gap here, I'm taking the trade. I see a gap here, I'm taking the trade. I see a gap. No, that's not how it works. So how exactly do you use that, and how you can objectively take the advantage out of it? All right. So a lot of people, they use it as their TP. So what they do is, like, for instance, they take a trade. So let's say that someone takes a buy over here, right? So let's say they take a buy over here, and then what they do is, like, they use it as a TP because they know that once price gets there, they're gonna have a reaction. Now, nobody knows what type of reaction you're gonna have, but there is a probability that you can have a reaction. Sometimes it doesn't even have a reaction, it just goes through it. Okay. And then some other people, what they'll do is that if they have a higher target, they're gonna start taking partial. So they take a bit of partial here, a bit of partial here, and they leave the rest run to the upside. And finally, some people, they can also use that as an entry model. Okay. So if, let's say, for example, now, all right, let's say this one. Okay. So let's see, price is low, then it's going higher. Now it's retracing. So a lot of people, they use it as a, let's go to smaller time frame, and let's see if we can see an imbalance. All right, look, this is very beautiful and clean as well. So you see, there is a gap between this and this zone over here. You see how nice is that? Price comes to it, taps, and it gives you a reaction. So there are many ways that you can take the advantage of this. And just to give a recap, is using as your TP target, using as your partial target, using as your entry model. Okay. And a lot of people will also, you'll see a lot of people also talking about that, how they use the 50% of imbalance. So using the 50% of imbalance is pretty much simply doing this. Let me show you. So you have a huge candle, like, see this one going to the downside. So what people will do usually is, like, they're taking this week to this week, they measure the 50%, and they're like, okay, I'm taking the trade from there. Now, me personally, I don't like to do this, because if I know the price has to come and fulfill this zone here, right, I want to see the whole imbalance to be filled, because sometimes what it can happen is the price taps to it, then it gives you nice reactions, and then you probably enter on it because you feel like, oh, I'm taking out of an imbalance, and then what happens is, like, price is gonna take you out, and then it just goes to your direction. So in order to avoid any unexpected surprise, what I do is, like, I usually, if I have to mark it out, is mark out my zone and take the feel of the whole imbalance, because I know then I can take a very nice trade from there. Hope this video was helpful for you guys. If you really liked and enjoyed it, please subscribe and leave a like.